On July 29th, the day before WESCO International released its second quarter earnings, institutional investors were in a defensive crouch. The stock dropped 6.44% as the broader market braced for a cyclical industrial slowdown. The narrative shifted on July 30th. WESCO shares surged 11% in a single session. The catalyst was a significant earnings beat, delivering an adjusted EPS of $4.57, clearing estimates by 14.8%. However, management simultaneously slashed full-year free cash flow guidance by $200 million. This presents a paradox. Institutional finance professionals aggressively bid up the stock even as the company admitted it will generate significantly less cash this year than originally projected. To understand the rally, we have to look at exactly why that cash is missing. WESCO has long functioned as a traditional industrial distributor, shipping cables and switchgear into the cyclical flows of construction and manufacturing. The second quarter results indicate a shift in operational focus toward the physical infrastructure required by hyperscale AI data centers and grid modernization projects. Total company data center sales rose 45% year-over-year in Q2, contributing to record consolidated net sales of $6.66 billion. The most aggressive growth appeared in the backlog, which surged approximately 60% compared to last year, as WESCO began taking on complex integration roles. This rapid scaling creates success-based working capital friction. Funding 60% more projects than last year requires immediate cash for inventory and credit, locking liquidity onto the balance sheet before the final bill is paid. This chart tracks the revenue mix of WESCO's three strategic business units. In Q2, all three beat estimates. The Communications and Security Solutions segment generated $2.68 billion in sales, expanding its adjusted EBITDA margin from 8.8% to 10.2%. Management attributed this expansion to procurement scale and a strategic focus on high-value technical services. That technical service demand is tied directly to the AI boom, where data center solutions revenue grew roughly 45% year-over-year. By attaching itself to the AI infrastructure CapEx cycle, the CSS segment is proving that WESCO has permanently elevated its baseline earnings power. To understand those technical services, we have to look past abstract financial metrics and examine the physical density of a modern hyperscale project. This schematic illustrates the complex engineering WESCO deploys for data center customers. Inside the facility, thermal management systems rely on liquid cooling piping and distribution units. Outside, heavy industrial chillers and cooling towers in the mechanical yard support those internal systems. WESCO is now engineering and installing high-voltage grid services and mission-critical cooling, whereas their previous model focused on shipping bulk cabling and basic switchgear. To execute these specific designs, WESCO recently closed a $135 million acquisition of Newark Engineering, a firm specializing in mission-critical cooling. That acquisition also secures an immediate operational footprint in the rapidly expanding Southeast Asia data center market. By integrating earlier into the data center lifecycle with thermal systems, WESCO locks in multi-year customer commitments and justifies that 60% surge in backlog. But this scaling brings us back to the bearish concern. If margins are expanding and backlog is surging, why did operating cash flow plunge 50.2% to just $53.7 million? Walking down the cash flow statement from adjusted net income reveals where the capital went. Trade accounts receivable increased by $183 million. Then, a $155 million increase in inventory and supplier deposits brings us to the final operating cash flow. Scaling massive data center and high-voltage grid projects requires WESCO to purchase inventory and extend credit long before those components are installed and built. This cash consumption is compounded by rising interest expenses, costing $110.4 million this quarter to service $5.91 billion in long-term debt. This upfront capital requirement is why management lowered their full-year free cash flow guidance to the $300 to $600 million range. WESCO's cash flow contraction is the mathematical reality of funding a massive CapEx cycle. It is the cost of rapid growth, not an indicator of deteriorating financial health. Institutional investors looked past the near-term cash drag because management simultaneously raised their operational forecasts for the remainder of 2026. The company raised its full-year organic sales growth target to 9 to 11%, a notable jump from the prior 5 to 8%. They also increased full-year adjusted EPS guidance to $16 to $17.50. That new midpoint of $16.75 per share significantly outpaces Wall Street's previous consensus estimates. These upward revisions signal to the market that WESCO's underlying earnings power is accelerating faster than the temporary working capital friction is dragging it down. That $6.66 billion backlog consists of highly sticky, multi-year commitments from major hyperscalers and utilities. The cash flow headwind hits an inflection point once these complex high-voltage and liquid cooling systems finish shipping and the billing cycles finally mature. The overarching financial rule governing this transition is straightforward. Cash conversion inevitably follows the CapEx cycle. The Q2 print confirms that WESCO's revenue is now structurally linked to the AI infrastructure cycle. This shift in underlying earnings power explains why the market chose to ignore the cash flow contraction and re-rate the equity.